All you need to know about the collar strategy. A collar is an option strategy where you buy shares, buy a put option to protect against downturns, and sell a covered call to help fund the put and possibly earn some income. Let's look at a collar on Amazon, where we hold 100 shares, buy a Delta 13 put, and sell a Delta 13 call. Amazon is currently trading at $226.20. As you can see in the payoff diagram, the collar protects our shares on the downside, but it gives up the upside beyond a certain point. If you think the stock is unlikely to rise sharply, this can be a great strategy to protect your position during bear markets. The main risk with the collar strategy is the stock rising rapidly above the sold call. The strategy has its highest delta when the stock is in the middle of the strikes. This shows that we keep most of the upside while the stock is below the call strike, but as the stock gets closer to and above that strike, we give up more and more of the upside. If the stock drops instead, the put gradually reduces our delta, which means we stop losing money as the stock keeps falling. An important point is that when we enter the trade, we already give up some upside and gain some downside protection, even before the stock gets close to the strikes. If the stock rises $1 on the same day, the overall strategy only makes about 73 cents, given the delta of 0.73. And if the stock drops $1, it only loses about 73 cents. As time goes on, our delta becomes more concentrated in the middle of the strikes. The options need to move closer to their strikes to have meaningful value and impact the payoff. At expiration, delta is 1 between the strikes and 0 outside of them. We keep all the upside and take all the downside, but only up to the option strikes. The collar's vega is positive when the stock is closer to the put strike. This is an important benefit because market drops are usually accompanied by higher implied volatility. That positive vega gives us an additional boost to P&L during downturns. However, in situations like earnings or other major announcements the market has been waiting for, implied volatility often drops instead. In those cases, a downturn may come with a volatility crush rather than a volatility increase.